Module 3, investment analysis, begins by looking at the stages of a company's development and the sources of capital that a company can look at. It begins then at the beginning stages with a startup company. And you see here with this slide on page 14 that sales and earnings typically grow over time. At some point, every company starts with, at the very beginning, with zero sales and zero profits. But as we go along, our sales grow, and hopefully, if we can control our expenses, our profits will also grow. And we see here, much like in the product life cycle, we have a company life cycle. It begins with venture capital in the startup phase. It moves then from there to the growth phase, where a company is growing faster than it's able to support based on its own level of earnings, which means that in this particular case that external sources of capital become necessary. And of course, we have private equity for businesses that are not at the stage where they can go to the public capital markets to source capital. Private equity becomes a source. As we move along and start to expand, our business is achieving not only higher levels of sales, but our earnings are growing too, and our earnings are growing beyond what we need to finance our own investments. That means we have money left over at the end of the day to pay our shareholders in the form of dividends, to pay bank loans back, and to make investments with. And as you see in the expansion phase, a company at this point is also looking to grow its business maybe faster than the market, and that means looking at opportunities to either grow through an expansion of products, or looking at new markets in which to sell existing products. And both of these points can be achieved through mergers and acquisitions. And oftentimes it is, for example, if a company is looking to grow faster than the market, it may consider buying a competitor, or it may look at companies that offer complementary products. A good example here is Microsoft, by the way. Here as a local example in Northwest, Microsoft is a firm that has significant financial resources and cash, and they use that cash oftentimes to buy smaller companies that don't have the money to take their products to market. And through this means then, by acquiring companies that have interesting product ideas, Microsoft can then sell these products then through their marketing channels. We see the same situation happening too in the biotechnology industry, where biotechnology companies are oftentimes bought by pharmaceutical companies that use the products from the biotechnology companies to enhance their product programs. Likewise, you could grow your business too by trying to expand into new markets. And when we do that, oftentimes it means going abroad, where we have to create new sales organizations and have to have local understanding of local market conditions. And that oftentimes may be more quickly achievable by buying a local company or hiring local staff than trying to do it on your own. And finally, in the final phase that you see here, the exit phase, is a phase where the business goes through a transition of ownership. I'm thinking about private companies, and most private companies will not go to the stock market in the form of an IPO, which means if the owner of the business is approaching retirement, what can he do if he wants to transition the business over to the next generation? Obviously, he could transfer the business to children within the family, or he may even think about selling the business to a private equity investor. He may sell the business, let's say, to managers that are not currently owners. And these are some of the different options. This also involves a mergers and acquisitions process. And as you see right here, there's some of the options here. We also have, eventually, if the business is big enough and it qualifies, and meets the necessary prerequisites, it could go to the capital markets in the form of an IPO. Types of financing. We see these right here, and I'm not going to go through each one of those. I just want to make you aware that of the different various types of financing. Starting from the left with cash flow, which is internal, that's what we're generating from the business. In external forms, like bank debt. In other words, you're all familiar with bank debt, borrowing money from a bank and paying interest. Private equity is also a source, and we're going to be spending a lot of time in this course talking about private equity. This represents an alternative form of capital. In other words, these are investors that go out on the market, collect funds from various institutional investors, and then essentially look for investment opportunities and manage this money for other institutional investors. We have the the capital markets. You're all familiar with the term IPO, initial public offering. Companies that fulfill the necessary prerequisites can become candidates then for the public capital markets. There are bonds, and this is a form of financing typically open only to companies that have a rating, oftentimes with one of the established rating agencies that you may be familiar with, like Moody's, Standard & Poor's, or Fitch. And we have other forms of, I call this financing. We could take a look at leasing, that you're all probably familiar with. In other words, rather than buying an asset and financing it with a loan or with our own capital, we can go and ask somebody else to buy the asset for us and then lease it to us at a certain rate, and we pay, instead of the interest expense, we pay we have leasing expenses. And finally, factoring is a form of financing. Like I mentioned earlier, if you need capital, you have the possibility of selling some of your assets, and factoring is doing exactly that. What you're doing is you're selling your receivables to a factorer, which is oftentimes, it may be a bank or it may be a separate independent factoring company, and they'll buy those receivables from you, but not at what they're shown on the balance sheet, but probably at a discount, maybe, who knows, 5 or 10%. And they face the risk, of course, of being able to collect the receivables when they're due in 30 or 40 days. The types of these types of financing, of course, as we see, are also here shown relative to the company's stage of development. And some forms of financing are not available because the company simply doesn't qualify. For example, in the beginning stages, in the venture capital stage, oftentimes it's very difficult to obtain loans because banks don't want to fund the losses that typically occur in the startup phase of a business. Banks feel that is a responsibility of shareholders, and it actually is. Here is a breakdown on page 16 of the external sources and internal sources of financing. And here are some of the characteristics that you typically see with each of these forms. I think the point that I want to make here is that internal sources of financing are those that come from the business cash flow. And external sources of financing are those that come from either shareholders or from banks. Now, you may say, well, a shareholder is an insider. That's true, but if the shareholder is making a payment into the company in the form of buying more shares, then that represents an external source of financing, even though the money is coming from an insider and not necessarily new shareholders. The types of capital we're going to be looking at throughout the course are basically debt and equity. And here we see some of the characteristics associated with each of these forms of capital. Debt capital is typically less expensive because oftentimes the debt capital in the form of loans is secured with assets of the business. In other words, the company has pledged collateral as security for the loans, which means if the company doesn't pay the loans back, then, of course, the bank has the opportunity to sell assets to recover the loan value. If a company's assets are not worth as much as the debt, then the company has a real problem because at the end of the day, the debts are not covered by the assets. And in that particular case, the bank will probably ask the shareholders to come up with some additional equity capital, meaning that they're going to have to increase the capital of the business. The shareholders, if they don't do that, and the company moves into a situation where they're unable to pay their debts back, then the shareholders will begin to lose control of their business, because when the debts cannot be paid back from the assets, then the shareholders do not receive any of their money back in the event of a default, and the company becomes what we call insolvent. And as we mentioned earlier, the two things we're trying to avoid is what I call a situation where we don't have enough cash, or the company being illiquid, or we have a situation where we don't have enough equity capital to cover the losses in our business, and then we're technically, we have a situation where we're insolvent. In other words, we don't have enough asset value to be able to cover all of our debts. And for that reason, by the way, because of that residual risk that equity shareholders face, their return requirement is always going to be higher than whatever the bank requires. And as I showed you earlier, the difference oftentimes can be as much as the return requirement might be double what a bank, for example, requires in the form of interest. To close out this module, I want to share with you how we can analyze financing requirements. And by the way, you're going to be able to practice this with an example then. This is the exercise then in discussion board activity 3. And here we have a linear model. In other words, what we're trying to show is that as we grow our sales, and presumably if we're making profits, then the question is, do we keep the profits in the business? In other words, do we retain them, or do we pay them out in the form of dividends? The more we retain in the business, the more money we have available to fund our investment requirements. And the assumption here is that as we grow our business, we are going to have to invest more to be able to support a higher level of sales and earnings growth. And this model here, if you take a look at it, assumes that as my sales grow by 10%, my assets are also growing by 10%. Now, that's not always the case, but there's typically a correlation between the amount of sales growth and the amount of growth in current assets. And in this particular case, our investment requirement is 10% of our total balance sheet of 1,000, which means 100. And in this particular case, part of that can be recovered by asking our suppliers to accept longer payment terms. And by growing our current liabilities, presumably they're also a variable position like the current assets, we can offset some of our funding requirement. If I take the required investment of 100 and deduct the increase in current liabilities, and in this particular case subtract out the amount of retained earnings, that yields the external capital requirement, in this particular case 32.5. Now you may think about what you can do to lower our external capital requirement. And clearly I think we need to take a look at the amount of investment required. The question is, do we really need to make investments in fixed assets or not? The other question is it possible for us to get our suppliers to stretch their payment terms? Let's say we pay our bills let's say our customers pay us in 30 days, and we can negotiate with our suppliers to pay our bills in 40 days. In that particular case, that would lower our external funding requirement. And finally, retained earnings is obviously a major source. If there are times where we need to make significant investments, management may simply say they're not going to pay dividends in that particular year. And in that particular case, we have more money available than to cover our external capital requirement. The available internal financing, the 4.3 that you see there, represents the growth rate at which the company could grow, where the external financing requirement would be exactly equal to 0. So if you replace the 10% sales growth rate with 4.3, that would yield an external capital requirement of exactly 0. And here on page 19, you have the opportunity to do this exercise then on your own, and then share with us your thoughts then in the discussion board. That concludes Module 3.